Hi, Barbara Friedberg here, former portfolio manager and university investments instructor. And today I am so excited to have Paul Merriman here with us.
It's great to be here. Thank you so much for inviting me, Barbara. It's an honor. Thank you.
Well, wonderful. Well, we're going to be talking about asset allocation and asset allocation by age. But before we get going, I need to tell you a little bit about Paul, even though I'm sure most of you already know him. He is a nationally recognized authority on mutual funds, index fund investing, diversification, buy and hold, active management strategies. He is now retired from his firm, Merriman Investments, the Seattle-based company that was an advisory firm founded in 1983, and he is dedicated to educating investors through his website, podcasts, videos, and tons of information. His many books include the most recent, We're Talking Millions, 12 Ways to Supercharge Your Retirement. I happen to have a wonderful review of that book, which I love, on my website. And Paul's weekly podcast, Sound Investing, was recognized as a top investing podcast by Money Magazine. So, Paul, let's get started. What does asset allocation mean? We hear about that all the time. We hear it's important, but tell our listeners, what is it and why should I care?
Well, let's start with why you should care, because the decisions you make around asset allocation are going to drive most of the return. Some would even say as much as 99% of the return that you will get on your investments. Now, many people, when they think of asset allocation, they're really focusing on that balance of fixed income and equity. And what we know is the equity is the gas, the fixed income is the brake, and you can control how fast or how much slow you want to go in terms of volatility. And of course, we think in terms of that being an extremely important aspect of asset allocation, because if you don't have that right combination of equity and fixed income, you might bail out at exactly the wrong time. But there's another level that is as equally as important, I think, and that is inside that equity portion of that portfolio. Are you going to be conservative? Are you going to be moderately aggressive? Or are you going to be aggressive? Because there are many different ways to apply the asset allocation to those different equity asset classes. So stocks and bonds, and then the right stocks.
Well, thank you so much for explaining that. And you answered my next question too, which is why it is important. And let's talk a little bit about age. What does age have to do with that?
Well, I could say, depending on the background, the education of the investor, age might not have anything to do with the equity part of your portfolio, but it might have a lot to do with how much you have in fixed income. So usually when we think about people getting older, I'm 77. If you look at the glide path at Vanguard in their target date funds, they would say that I should be 30% in equity. Well, I've chosen to be 50% in equity and 50% in fixed income for the rest of my life, unless something really disastrous were to happen. So that combination of fixed income and equity typically has people slowing down, putting more brake on as they get older. But the equity portion, this is I think is a hot topic, at least in my mind, because if you invest in a target date fund at Vanguard, you will get the same equities, not percentage of equities. in terms of fixed income and equity, but the same kinds of balance of US large cap and international large cap. So you might be 30% in equities and be 70-30 US international in that portion of equities. You might be 21 years old and be 90% in equities and also be 70-30. So there are people who say, wait a minute, when I am young, wouldn't I want to be more aggressive than to be in the same equities as the person who's 91? And I would tend to agree. If they were educated, they understood the implications of more aggressiveness in the equity of the portfolio when they're young. I think it should be very different at 21 than at 91.
Are there any cases where you've got a 35 or a 40-year-old who shouldn't have a larger percentage in equities or an outsized, let's say, the target date fund for someone who's 30 or 40 might hold 90 or 80% in stocks because the thinking is that they've got a lot of time to make up if there are those losses. But are there people that are in their 30s or 40s that should not be in that aggressive a portfolio?
Guaranteed. Absolutely guaranteed. And we know that because something like 23 or 25% of millennials are not taking any equity position at all. And the reason they are not is because they believe that investing is gambling. They believe that investing is speculation. They believe if you put money in the equities, you're going to lose everything. So in order to get those people to some equities means we have to, as their teachers, show them what does it mean to have 20% in equities? What more would you make if you added 20% in equities compared to nothing? And it's over 1% a year. And as you know, Barbara, an extra 1% is literally life-changing over a lifetime of saving and investing. So there's that group. Then there are the group that are really not sure. They know they need to have some equities, but they also know, if they listen to people like you and me, that sometimes the market goes down 50%. And if you can't deal with that, you better figure out another way to try to have enough equities. So we've done some studies where it was 60-40. In essence, from the day you're born until the day you die, you could be 60-40. And I'll tell you, if somebody becomes comfortable with a 60% equity, 40% fixed income, and they do that for 20, 30, 40 years, I think they're going to be comfortable doing that as they get into retirement. And the returns are absolutely fabulous. And so I just want to get as much equity in that portfolio as I can when you are young, because that's the time you should be taking more risk. There'll be plenty of time to slow down later. But if we can't get you where we want to get you as far as we can get you to go.
So the takeaway really is you've got to get started investing now, no matter how old you are. And if you're really, really frightened of losing, because like you said, Paul, it is not unusual that on occasion, a global diversified stock portfolio in 1 year might lose 30 or 40%.
More. I mean, we got to tell them more, I think.
Well, that's true. There have been a few years where it has lost even more. And that's why we diversify. That's why we have some bonds and fixed income, because unless you are hugely aggressive, you want some fixed income to offset huge losses that might occur in the future. But like you said, if you're really, really scared and you don't feel like you can even handle a 10% loss, well, then even if you're 35 or 40, what you said, Paul, I think is really important. First of all, you want to educate yourself about investing. And that new book you have out, We're Talking Millions, is an amazing place to start. And you want to have a little bit of money in equities, even if you are scared.
And you know, something
So,
that might help, Barbara, is uh, there's a page of returns. I think I even sent you a table, a series of fine tuning your asset allocation tables. And I think it'd be great. I mean, I don't know if you can put that on your site and let people come and take a look at it. But here's,
I will find it and I will put it, a link to that, in the bottom description of the video.
and I'll tell you what it'll do for them. It will show them not only how much you would have made since 1970, and every year it shows you the return, if it was good or bad. And at the bottom of the page, it shows you the worst 12 months, the worst 36 months, the worst 60 months. It sets you up for reality, not for dreamland. Because if you've got a hold of reality, when it comes, you're ready for it and you stay the course. But that will show you, let you see that every 10% difference in equities, from no equities to 100% equities. Those tables show you what happened over the last 51 years. That's history, and that's what we want investors to see.
And Paul, I'm curious. Tell me, for people that have shorter term goals, let's say they're not investing for retirement, but they've got a goal that's maybe 5 years or 10 years down the road. How do you invest with those monies for shorter term?
Well, it depends on the rest of their portfolio. In some cases, you'll have people who have long-term holdings where they're sitting on 50% in fixed income. And so it may be that you could be a little more aggressive with that money. I mean, normally, if it's 5 years, planners will tell you, don't take any risk. If you know you need that money, put it in a short-term bond fund. That's what my wife and I do each year with the money that we're going to use for that year. We put it in the Vanguard short-term investment grade bond fund. We make better than a money market fund, a little bit of risk, but the bottom line is that it's not too much risk for us. And you need to know what that risk is. But for people who, let's say, want to think about 10 years, then I'd like to see them take a little bit of risk. Now, how much that is could be, for example, there's the Vanguard, they have these life strategy funds, and one of them is called the income, but it's 20% equities. There's another one that's, I think it's the conservative, and it's 40% in equities. Or if you own the Wellesley fund at Vanguard, 60% in fixed income, 40% in Wellesley. In equities, I wouldn't want to be any more aggressive than that if you need that money. Now, if it is one of those things where, okay, when we get to X, whether it takes 5 years or 10 years or more, I might take a little more risk, because it's not like you have to have it at a particular period. So that makes a big difference. If you really, really need it, then you don't want to take much risk. And for some people, none.
Thank you so much for clarifying that, because especially with new investors, we get questions a lot of, well, I'm saving for a home down payment. Where should I invest? And the answer is, you should invest in a CD or a short-term bond fund, because you can't afford to lose 30% of your stock portion of your investment if you need the money in the next 5 years.
Yeah.
So we're going to get into portfolios now, and you've already touched on that a little. I like that you shared some of the Vanguard offerings, and we love Vanguard because their fees are very low and they're known for being very, very investor friendly. Mm-hmm. So how can I set up my own investment portfolio that's in line with my risk tolerance without a huge amount of work. So, what are some of your portfolio investment strategies?
Well, Barbara, we have, if you came to our website and there is a link to recommendations. And under recommendations, there's Vanguard and Fidelity and Schwab and T. Rowe Price, and then ETFs. If you wanted to use ETFs, again, you can get those at Vanguard or Fidelity or Schwab, and they're commission free. But the recommendations run the gamut from 40% equity, 60, and 100%. So that would, in our mind, to keep it simple, that would be the conservative, the moderate, and the aggressive investor. And then we tell people how much we want in each one of those different funds. When I say different funds, US, international, small, large, value, growth. And you're thinking to yourself, as any person would probably, do I want to fool around with all of these different funds? So for those people, we have some portfolios that are, I can't say dirt simple, because we want to do a few things to give you a chance to make extra money that will be meaningful in how soon you get to retirement or how much you have to spend in retirement. And so we have a 4-fund strategy in the US. You can put fixed income along with that. We have a 4-fund strategy for US and international. You can put together as much fixed income as you want there. And again, those fine-tuning tables that you have, you're under control. They're yours. There is one for each of those portfolios, the 4-fund, US and international, et cetera. And you need to find that combination that's going to give you peace of mind. Now, for some people, 4 funds plus bond funds is just too much. So as you know, one of our favorites is what we call 2 funds for life.
I love this portfolio. I think this is such a unique idea, and I want to make sure you tell them the why of it.
Well, first of all, we want it to be as simple as it possibly can be, with the belief then that somebody would actually do what we're going to ask them to do. Because the target date fund is, without any question, as far as I'm concerned, America's #1 retirement investment. Because inside that target date fund, you might not know one thing about investing, but if you know you want to retire 40 years from now, you could put your money in the target date fund that's for people retiring in 2060. And it's that easy. What will happen then is, whether it's Vanguard or Fidelity or BlackRock or almost any major Fidelity mutual fund company is going to have these target date funds. Now, some of them I don't like. And I don't like them because they're actively managed. And when they're actively managed, it means that the fees are going to go up, and the turnover, the expenses inside are going to go up, and the returns are likely to go down. So I'm voting for target date funds that use index funds as the underlying investments. But the managers, they know, at least based on all the right thinking within the industry, about how much you need in stocks from age 20 to 30 to 40 to 50 to 60, and they will make the adjustments over time. Now, the reality is that means they kind of have to do it for the average investor when they do that. They can't do it for the real aggressive, or they can't do it for the ultra conservative. So you're going right down the middle of the line, very similar to the way a pension trustee would manage money for people who are going to retire from the government or a corporation and have to have monthly income for the rest of their life. It is an amazing product. That's the good news. The bad news is they are missing some asset classes that historically would make you potentially a lot more money. And so we have two ways, basically, that you can build these two funds for life. The two things you are missing in those target date funds, almost all of them, you don't have enough small cap and you don't have enough value. And the good news is you can actually buy mutual funds that specialize in small and value. So you can beef up your portfolio. I don't mean wild and crazy beef up. I mean conservative. For example, you could put 90% of your money into the target date fund and 10% into the small cap value fund. You could do that at Vanguard. You could do that at Fidelity. And we give you the funds you could use if you wanted to. And what you would do is you would continue to put 10% in one and 90% in the other. And by the time you get to retirement, if you're in your 20s, your 30s, you could legitimately have 30% more money in that retirement fund. Now, that is not a small amount of money. If you were going to have $1 million, it means you'd have $1.3 million. All right, but let's just say you're taking out 4%. Instead of taking out $40,000, you could take out 50,000 plus and have access to more income in your retirement and leave more to your children and charities, those are the two things we want to do. Live it up without outliving our money. That's number one. And number two, do some good with it at the end of our life. And if with one simple small change in your portfolio, you could up the return that you have at age 65, 30%, I think it's worth the small amount of extra risk that you take. Now, there's a second way that you could do it. That is, it's a little more complicated, but it's so beautiful. And I didn't develop this. A guy named Chris Pedersen, who is the head of the research department of our foundation that we have educating people. And its simplicity is beautiful. You take your age, let's say you're 30, and you multiply that times 1.5. Well, that would then be 45. That's the amount that you would have in the target date fund. The rest you would have in small cap value. And as you get older, when you're 40, now what happens is you've got 60% in the target date fund, 40% in small cap value. When you're 60, you've got 90% in the target date fund, 10% in small cap value. And when you have, let's say, retired at 65 or 66, you're out of the small cap business and you have a very conservative retirement. So instead of putting a little bit of small cap value in when you're young and can take more risk, you put a lot. And as you get older and older, you keep taking some out and putting it over in the conservative pile. It is an amazingly simple, easy to do if you can multiply your age times 1.5. And that's
Hopefully we can do that.
Yes, I hope so. Or find somebody who can, whatever.
Okay. Now, Paul, why small cap value? Tell our listeners what's the magic in that type of fund and why you selected that to add to a target date fund.
Well, here's what the academics show us. They have back tested back to the 1920s the return of what is called large cap blend. That's what the S&P 500 is. Very large companies and a combination of some growth companies and some value companies. And so that is what we know as the 10% asset class. It has, since 1928, compounded at about 10% a year. By the way, That's a very fine return. You double your money about every 7 years. If you wanted to make 1% more, you would buy a mutual fund or an ETF that invests only in the value. The value companies, they'd be large companies, just like those large companies in the S&P 500, except they would not have the growth. They would have the companies that are out of favor. They're a little more risky as a group. And the historical return for those is 11% approximately. Well, every 0.5% we can add in return over a lifetime of investing is worth over $1 million for most people. And that's without putting tons of money away. So an extra 1% is a big deal. Then small cap blend, smaller companies, again, some growth and some value. That adds about another 1%. So now instead of the 10, less risky, that's how it works. You take less risk, you make less money. Put your money in bonds, you make less money. Why? Because you're taking less risk. There's no magic to any of this. Then the small cap, as I said, at 12, but when you go to small cap value, it's about 13. Now, that's the past. There is no risk in the past. We all know what we should have done in the past. We should have put our money in the Seattle area in 1986. Why didn't I just put $10,000 in Microsoft?
Microsoft, yes.
That's it. It's all over.
Yes.
But, and I know people who did, and they've done well. But the fact is that if you could buy value and small in that index, you have a chance with 10% of your portfolio to make 13% potentially. Now, the 40-year average for that asset class is about 16%. 16. 12 would be fine. I'd be ecstatic with 12. And so small cap value makes up for the lack of the small and the value. And that keeps it real simple. You're going to have tons of large cap in that target date fund. More than you need, by the way, more than you need.
Well, that was a great explanation. And what we need to know is when we look at history is it makes sense that if you buy an asset on sale for a price less than it's worth, over the long term, it will tend to outperform. And that's what the value holdings do. But remember, as Paul said so eloquently, these are long-term historical returns. So don't get in and invest in a small cap value fund today and email Paul or me next year and say, we didn't get oversized returns, you're idiots, because we're talking long term. So email us in 20 years.
Yes, and let me tell you something, Barbara. There's a thing that we have produced called the Telltale Chart. And that name we think came from John Bogle. But what the Telltale Chart does, it shows you over time accumulated returns of the S&P 500 and, for example, small cap value. And we can see the period when small cap value was outperforming. And we can see the periods where they kind of moved sideways and they both got the same. And then we can see in fact, we can see the periods that the S&P 500 did better.
Like the last 10 years, right?
Exactly. And you look back at the last year and small cap value is trouncing the S&P 500. I mean, it's like a 100% difference in the return in some cases. So it turns out that over a 92-year period, that 72 of those years, basically the S&P 500 and the small cap value did the same, approximately. It was the other 20 years that made the difference. So for me, 77, I may die and not see the advantage. But to a 20 or 30-year-old, the odds are so much in their favor. Not because I can tell you whether it'll be 2% better or 3% or 4 or a half. I can't. But all of the academic evidence says you will, if you own the group, not if you try to buy one stock, own the index, you will, there's a very high likelihood you will get a premium for having taken that risk, just as I think you will get a premium for buying stocks instead of bonds. But I can't guarantee that either. Bonds may outperform stocks for the rest of my life.
Thank you for that perspective and those details, and really the insights that you have had on deciding what asset allocation is right for you, depending on your age. Paul, is there anything else we need to cover today before we wrap it up?
Well, always it's perspective. Always it's a matter of taking the time to get an education, that you know what investing looks like in the good times and the bad. I am fearful for young people today because we already know that people who have things to sell can manipulate young buyers like never before. And that means they're spending money on things they might not likely need, but people have created the picture. You know, they know who you are, and they're coming after you. Now, I think about that in terms of investing. You now have all this free information on the internet. And here we have portfolios that anybody for nothing can just pick our brain. But what if our brain is really thinking about how we're going to benefit ourselves instead of benefiting the investors? It is possible that the story behind, oh my gosh, GameStop, that story was about somebody manipulating a bunch of people to do something that benefited them first and foremost. That's not what we want young investors to do. But unless they get the basic information, which is what we're talking millions, is an attempt to do. 12 things you need to know. If you know those 12, you're 99% of the way there, I believe. And you teach the same kinds of things. There's nothing in that book that you don't teach, except maybe the 2 funds for life. And now you're ready
Which I'm going to be teaching from here on out because I love that strategy.
That's great. But thank you. Thank you for the opportunity to share.
Paul, it was a pleasure having you on. I appreciate your cautions and encourage everyone to be careful about who you listen to and who you take advice from. If you like this video, please give us a thumbs up and subscribe. We will put resources to some of the topics we've discussed in the video in the bottom in the notes so that you can follow up and even learn more. Thank you so much for listening, and we will see you next time.